What if I told you the conventional wisdom about striking it rich in the stock market, meticulously researching individual companies, hoping to uncover the next Apple or Amazon, is, for most people, not just inefficient, but a well-intentioned myth holding them back? For decades, the dream of financial freedom has been intricately linked to the allure of picking that one transformative stock, that single diamond in the rough that skyrockets your net worth overnight. But let's be brutally honest. How many of us truly have the time, the expertise, or frankly, the sheer luck to consistently beat the market by betting on individual companies? The reality for the vast majority of investors is far less glamorous and often leads to disappointment, stress, and underperformance. This isn't a judgment, it's an empirical truth backed by mountains of data showing that even professional fund managers struggle to consistently outperform broad market averages. So if the traditional path is a statistical long shot, what's the alternative? What if there was a millionaire code accessible to everyone, not just the Wall Street elite or the savviest traders, that has quietly, steadily, and demonstrably created more millionaires than any single stock in history? And crucially, what if this code is more relevant, more powerful, and more urgent for your financial future right now than ever before? This isn't just about making money, it's about democratizing wealth creation, leveling the playing field for the everyday investor. Forget the noise, the endless stock tips, and the speculative gambles. Today, we're cutting through the complexity to reveal a simpler, more effective strategy that harnesses the fundamental economic principles of global growth and innovation, rather than relying on individual corporate heroes. We're talking about 3 specific exchange-traded funds, or ETFs, that embody this strategy. Now, before we dive into the specific names, let's quickly clarify what an ETF actually is and why it represents such a significant leap forward compared to buying individual stocks. Imagine, instead of buying shares in just one company, you could instantly buy a tiny slice of hundreds or even thousands of companies all at once in a single transaction. That's essentially what an ETF allows you to do. Think of it as a diversified basket of stocks, bonds, or other assets, professionally managed and traded on stock exchanges just like individual shares. But here's where the magic truly begins. Unlike actively managed mutual funds, many ETFs are designed to simply track a specific market index, like the S&P 500, which represents 500 of the largest U.S. companies. This is what we call passive index investing. Instead of trying to guess which companies will win, you're essentially betting on the entire economy, or a large segment of it, to grow over time. This approach offers several compelling advantages for the average investor, far surpassing the potential and the peril of individual stock picking. Firstly, diversification. By owning an ETF that holds hundreds or thousands of stocks, you inherently spread your risk. If one company falters, the impact on your overall portfolio is minimal because you're also invested in hundreds of others that might be thriving. This stands in stark contrast to individual stocks, where a single bad earnings report or a market downturn for one company can decimate your investment. Secondly, ETFs typically boast incredibly low expense ratios. Because they don't have expensive teams of analysts constantly trying to beat the market, their operational costs are significantly lower, meaning more of your money stays invested and compounds over time. This seemingly small detail has a monumental impact on long-term wealth accumulation. Thirdly, ease of access. ETFs are incredibly easy to buy and sell through any standard brokerage account, making sophisticated, diversified investing accessible to virtually anyone with an internet connection and a modest sum of money. This democratizing aspect cannot be overstated. It means you no longer need a large capital outlay or exclusive access to high-end financial advisors to build a robust, growth-oriented portfolio. The fundamental economic principle underpinning the success of these broad market ETFs is straightforward. The global economy, driven by human ingenuity, innovation, and productivity, tends to grow over the long run. By investing in a broad index, you're not just participating in this growth, you're capturing it across a vast spectrum of industries and companies. You're not relying on one company to invent the next big thing, but on the collective output of thousands of companies innovating and expanding. It's a testament to capitalism's enduring engine, allowing you to ride the long-term upward trend of the market without the impossible task of identifying tomorrow's winners today. So instead of trying to catch lightning in a bottle with a single stock, these ETFs offer a systematic, proven way to capture the steady, powerful currents of market growth. They represent a paradigm shift, moving investors from speculative hope to strategic certainty. They have been the quiet workhorses, the silent engines of wealth for countless individuals who understood that sustained, broad market exposure, coupled with the magic of compounding, is the true millionaire code. Are you ready to unlock it? If you want to help the channel, please leave a like and subscribe. It helps the channel a lot and helps other investors see the video. So, let's continue. The previous section ended with a powerful thought. Understanding broad market exposure and compounding is the millionaire code. Now, let's peel back the layers on the specific instruments that have so effectively translated this code into wealth for countless individuals. We're talking about the titans of the market: VOO, SPY, and QQQ, ETFs that don't just track the market, they are the market for many investors. First up is VOO, the Vanguard S&P 500 ETF. Launched by the legendary John Bogle's Vanguard, VOO offers investors a piece of America's 500 largest publicly traded companies. It employs a full replication strategy, meaning it aims to hold every stock in the S&P 500 index in proportion to its market capitalization. This market cap weighting ensures that larger, more influential companies like Apple, Microsoft, Amazon, Alphabet, and Nvidia naturally have a greater impact on the ETF's performance. Vanguard's unique client-owned structure means its ETFs are renowned for their incredibly low expense ratios, and VOO is no exception, boasting one of the lowest at just 0.03%. This means more of your money stays invested, compounding over time. Furthermore, Vanguard's patent on its ETF share class structure within a mutual fund often grants VOO a distinct tax efficiency advantage, making it a favorite for long-term buy and hold investors. Then we have SPY, the SPDR S&P 500 ETF Trust, the original S&P 500 tracker, launched way back in 1993. It wasn't just an ETF, it was the first ETF listed in the United States, pioneering a new era of accessible investing. Unlike VOO's corporate structure, SPY is set up as a unit investment trust, which has some implications. While it tracks the S&P 500 with similar precision through full replication, its UIT structure means it generally cannot reinvest dividends directly. They must be paid out to shareholders. This can lead to slightly less tax efficiency compared to VOO for certain investors. However, SPY's unparalleled trading volume makes it the most liquid ETF in the world, a darling of institutional investors and day traders alike. Its expense ratio, though still low at 0.09%, is slightly higher than VOO's, reflecting its different operational structure and market positioning. Rounding out the big three S&P 500 trackers is IVV, the iShares Core S&P 500 ETF, offered by BlackRock, the world's largest asset manager. IVV is very much a direct competitor to VOO, also structured as an open-ended investment company, allowing for efficient dividend reinvestment and generally better tax treatment than SPY. Its expense ratio is equally competitive at 0.03%, matching Vanguard's VOO. For most long-term retail investors, the performance differences between VOO, SPY, and IVV are negligible over time, as they all track the exact same underlying index. Your choice often comes down to personal preference for the issuer, slight differences in trading volume, SPY being the leader, or subtle tax advantages. Now, let's pivot to a different beast, QQQ, the Invesco QQQ Trust. While VOO, SPY, and IVV cast a wide net across the S&P 500, QQQ zeroes in on the NASDAQ 100 index. This index comprises the 100 largest non-financial companies listed on the NASDAQ stock market. It means a heavy concentration in technology, consumer discretionary, and communication services sectors. Think of it as a turbocharged engine compared to the S&P 500's broad-spectrum stability. Its top holdings include giants like Apple, Microsoft, Amazon, Nvidia, Tesla, and Google's parent company Alphabet, often with even heavier weighting than in the S&P 500 ETFs. This sector focus is what sets QQQ apart. It's designed for growth, often exhibiting higher volatility, but also delivering explosive returns during tech-driven bull markets.
However, this growth-centric approach also means it can experience sharper declines during market downturns, making its risk profile higher than a broad S&P 500 fund. Its expense ratio is 0.20%, a bit higher than the S&P 500 trackers, reflecting the specialized nature of the index it tracks. Historically, the S&P 500, represented by VOO, SPY, or IVV, has delivered average annual returns of around 10% over the long term, proving incredibly resilient through countless economic cycles. While their expense ratios differ, 0.03% for VOO and IVV and 0.09% for SPY, their net returns over long periods tracking the same index are remarkably similar. QQQ, on the other hand, has often outpaced the S&P 500 during periods of rapid tech innovation and growth, sometimes delivering significantly higher returns. For instance, over the last decade, QQQ has often seen higher annualized returns than the S&P 500, but it also suffered more substantial drawdowns during bear markets, showcasing its higher risk, higher reward profile. Before we move on, it's worth briefly mentioning even broader alternatives like VTI, the Vanguard Total Stock Market ETF. VTI aims to capture the performance of virtually all publicly traded U.S. companies, not just the large caps in the S&P 500, but also mid-cap and small-cap stocks. While the S&P 500 ETFs are excellent for broad large-cap exposure, a total market fund like VTI offers even greater diversification, providing a complete landscape of the U.S. equity market. Understanding these nuances helps tailor your investment strategy, but for many, the beauty lies in the simplicity and effectiveness of VOO, SPY, or QQQ. These aren't just tickers, they're diversified portfolios managed by experts, accessible to everyone, and powerful engines for wealth creation. Before we continue, it's obvious you are getting value from this value-packed video. Why don't you kindly share and like the video to help other investors see this video? Also, tell us where you are watching from. Building on the incredible accessibility and expert management of ETFs like VOO, SPY, and QQQ, we now dive into the bedrock principles that truly empower them as wealth-creating machines. These aren't magic, but rather the immutable laws of financial growth, dollar-cost averaging, compounding, and the indispensable element of time. Understanding these isn't just theory, it's the framework for transforming your financial future. These simple yet profound concepts are the true secret sauce behind how ordinary investments can lead to extraordinary wealth. First, let's unpack dollar-cost averaging, or DCA. This is simply the practice of investing a fixed amount of money at regular intervals, regardless of the market's current price. Instead of trying to time the market, a notoriously difficult and often fruitless endeavor, DCA removes emotion from the equation. Why is this so effective? Because it systematically forces you to buy more shares when prices are low and fewer when prices are high, ultimately averaging out your purchase cost over time. Psychologically, DCA is a powerful antidote to fear. When the market inevitably dips, most people panic, but for a DCA investor, a downturn is actually a blessing in disguise. It means your fixed investment amount is now buying more shares of your chosen ETF, effectively accelerating your wealth accumulation for when the market recovers. You're building a larger ownership stake precisely when things look bleakest, turning potential anxiety into a strategic advantage. Next, we encounter what Albert Einstein reputedly called the eighth wonder of the world, compounding. This is the phenomenon where your investment earnings generate their own earnings. Imagine investing $10,000 today. If it grows at average of 7% per year, after 10 years, it's roughly $19,670. But here's where the magic truly begins. After 20 years, it's nearly $38,700. And after 30 years, it's over $76,100. The growth isn't linear, it's exponential because your interest is earning interest. The power lies in the snowball effect. A small initial sum, consistently added to and left to grow, gains momentum with each passing year. For VOO, SPY, and QQQ, this is supercharged by dividend reinvestment. Instead of taking cash payouts, you automatically use those dividends to buy even more shares of the ETF, creating an extra engine of growth that continually feeds the compounding cycle without any extra effort on your part. This often overlooked feature multiplies your share count, leading to substantially greater wealth over time.
The critical ingredient that allows both DCA and compounding to work their magic is time. We've all heard the adage, time in the market beats timing the market, and for good reason. A long-term investment horizon allows your assets to recover from downturns and fully benefit from compounding. Historically, despite wars, recessions, pandemics, and countless crises, the broad market represented by the S&P 500 has consistently delivered positive returns over any 20-year period. This empirical data offers profound reassurance. Staying invested through thick and thin is the single most important factor. It requires patience and a belief in long-term economic growth, but the historical evidence overwhelmingly supports this approach. Addressing market volatility and downturns is where these principles truly shine. When your portfolio is down, the human instinct is to sell and stop the pain. But panicking locks in losses. Instead, if you've committed to DCA, a downturn means you're buying more shares at a discount. If you understand compounding, you know that these cheap shares will be the engine of future exponential growth. The fear that paralyzes most investors becomes an opportunity for the disciplined few. Staying invested and continuing your regular contributions allows your portfolio to participate fully in the inevitable market recovery, turning what feels like a setback into an advantage. Beyond pure growth, ETFs offer compelling tax efficiency benefits, particularly when held for the long term or within retirement accounts. Because ETFs generally have lower portfolio turnover compared to actively managed mutual funds, they tend to distribute fewer capital gains, which are taxable events. Furthermore, dividends paid by these ETFs are often considered qualified dividends, which can be taxed at lower rates like long-term capital gains rates for eligible taxpayers rather than higher ordinary income rates. Placing VOO, SPY, or QQQ within tax-advantaged accounts like a 401k or IRA amplifies these benefits exponentially. Contributions may be tax-deductible, growth is tax-deferred, and withdrawals in retirement can be tax-free in a Roth account or taxed at your future income rate. This allows your money to grow even more efficiently, free of the drag of annual taxation. Finally, we must acknowledge the human element, the often overlooked aspect of behavioral finance. While these laws of wealth are immutable, our emotions are not. Fear and greed are powerful forces that can derail even the best investment strategy. This is where discipline and patience become paramount. Automating your investments through DCA, resisting the urge to check your portfolio daily, and understanding that market fluctuations are normal are crucial to letting these principles work their magic. The ETFs themselves are simple. The challenge often lies in our own behavior. It requires conviction, a steady hand, and the foresight to look beyond short-term noise. It's about having the fortitude to remain invested, knowing that these laws are quietly working in your favor, day in and day out, building your financial future $1 and one share at a time. So, you've grasped the incredible power of these millionaire-making ETFs and the fundamental laws of compounding. Understanding is half the battle. Now it's time for action. This isn't just theory. Your journey to financial freedom enabled by these investments begins with practical steps and a clear roadmap. Your first crucial step: choose your investment gateway, a brokerage. Research reputable online brokers like Fidelity, Schwab, Vanguard, or M1 Finance. Compare fee structures ensuring zero-commission ETF trades. Evaluate user interface and educational resources. Opening an account is straightforward: personal details, SSN, linked bank. Decide between a taxable brokerage or a tax-advantaged retirement account, Roth or traditional IRA, based on your goals. This decision lays your investment groundwork. Account open? Next, automate your investments. This is dollar-cost averaging in action. Instead of timing the market, a futile exercise, commit to investing a fixed amount regularly, weekly, bi-weekly, or monthly. Most brokers allow easy recurring deposit setup from your bank.
This isn't just convenience, it's a powerful behavioral hack. Automating removes emotion, ensuring you buy more shares when prices are low and fewer when high, averaging your cost. It transforms investing into a consistent, disciplined habit, building your portfolio steadily. Now, for traps that derail investors. First, market timing. The urge to sell before a crash or buy before a surge is strong, but truth is, nobody consistently times the market. Attempting it typically means missing best-performing days, significantly impacting long-term returns. Missing just a few key recovery days can severely reduce your growth. Your strategy? Time in the market, not timing it. Embrace volatility. Over the long haul, broad market ETFs trend upwards. Another critical mistake: selling low, often from panic during a downturn. When markets dip, instinct screams, "Get out." But selling then locks in losses and prevents participation in recovery. Market corrections are temporary. Long-term growth is the norm. Similarly, resist hot stocks or trending sectors, fads. By the time hype builds, much explosive growth is gone. Chasing fads means buying high and selling low. Stick to diversified ETFs. Their steady, unglamorous growth is your true wealth builder. These ETFs are powerful, but one component of a robust financial life. Before pouring every spare dollar into investments, build a solid foundation. Start with an emergency fund, 3 to 6 months of living expenses in a high-yield savings account. This shock absorber prevents selling investments during emergencies. Next, tackle high-interest debt like credit card balances. Eliminating a 20% interest rate offers guaranteed return far outweighing potential investment returns. Only after securing your emergency fund and addressing costly debt should you heavily invest. Consider where these ETFs fit into your overall portfolio. While powerful, they offer broad market exposure. Depending on age, risk tolerance, and goals, complement them with other asset classes like bonds for stability or international markets. Review your portfolio periodically, once or twice a year. This isn't active trading, it's ensuring your allocation aligns with your life stage. Life changes might necessitate adjustments. Finally, never stop learning. The financial world evolves. Staying informed empowers you to make wise decisions and maintain discipline.
Knowledge is your greatest defense. The path to becoming a millionaire or achieving significant financial freedom with these foundational ETFs isn't a secret. It's a journey of consistent action, disciplined saving, and patient investing. You now have the knowledge, tools, and understanding of pitfalls to avoid. Don't let paralysis by analysis or fear hold you back. Take that first step today. Choose a brokerage, open your account, and set up your automatic investments. Start small if you need to, but start. Commit to your financial future. Compound growth, relentless innovation, and dollar-cost averaging are waiting. Will you seize this opportunity? Inaction is the only thing stopping you. Begin your wealth-building journey now and let these ETFs begin to write your millionaire story.